Hi, this is Hille on the 18th of July 2013 with another trading video. Now here I am looking at the Nikkei futures contract, which is NIYU3, so that's the September Nikkei futures contract, and as you can see this is a 4-hourly chart. And if you haven't watched the Aussie USD video I put up today, watch that as well, because it talks about exactly the same technique that I'm using in this video. Okay, so again in this video, just like the Aussie USD one, I'm using a simple moving average 10 and 30, but on that video I was looking at the daily chart. Now I'm looking at the 4-hour chart. Now let me just change this, because you can see, and again as I said in the other video, this is where you can use some art as well as science to decide on what you're going to use to determine the buy or sell zone when you're looking at a trend trade. So in an uptrend you're looking for a buy zone, obviously, because you want to join the trend. In a downtrend you're looking for a sell zone. Now the reason I've got the 10 and 30 up here already is because the 10 and 30 was excellent in the run up in the Nikkei before the big fall a couple of months ago. So I'm going to pause this video and go back and show you what I mean. Okay, so here I am on the Nikkei. This is the continuous NIYC1 on my system, which is just aggregates all of the futures contracts, because if I just looked at the September one, this wouldn't give proper figures, because there wasn't much trading of this September contract back in February and March, so it gives the same information. So although it's not perfect, you can see, and you can create this yourself, but you can see lots of opportunities where price came into the 10 and 30 moving average and then went up. Obviously these weren't profitable, but this one was, this wasn't. That's a great one. There's excellent opportunities all through here until finally it peaks, and then interestingly enough on the downside, opportunities where it comes in to the 10 and 30 moving average sell zone before it starts going back up again. Okay, so that's really what I wanted to show you, why I'm looking at the 10 and the 30. So let me go back to the chart I was looking at before, so I'll pause again and come back in a second. Okay, so here we are back at the current September contract, and you can see the 10 and 30 is pretty good, but it's not absolutely perfect. So it looks like perhaps more the 10 and the 40 is going to give us a slightly better zone to look to join the trend. So there we are, I've changed it to a 10 and a 40. Now let me tell you the first thing that I don't like, well I do like about this chart, but I'm disappointed about. This here, that candle there, is the best opportunity to get long in this whole up move, right from, you know, when it bottomed out and started going up again, for the simple reason is that we've got a lovely small green candle in the moving average buy zone, and then a lovely opportunity to go long 1 point, or actually these trade in 5 points, so 5 points above there, and then with your stop 5 points below. It was a very low risk strategy. But as you can see down in the bottom left, this is an 8 PM candle for me, which closes at midnight, so I was fast asleep when this triggered. Had I stayed up and seen this candle, I most certainly would have got long, but I wasn't. I missed it. You can't sit and watch the screen 24 hours a day. So I missed that opportunity, but there have been some other opportunities, not nearly as attractive as that one, which just looks perfect, and as I said, fantastic, because it's very, very low risk, especially seeing as this is the 4-hour chart. I mean, what's the high there? 13,880, 13,765, so you're only having to take 115 plus 5 either side, 125 point risk on that trade. More opportunities here in the buy zone all through here. on a shorter time frame, on a 1 hour chart, you could have got in there. But here is the one I did get, thankfully, and I've been waiting patiently for this kind of this kind of candle. Now here is a good candle for me, because as you see, it says on the bottom left, it says 12 p.m. So that candle starts forming at 12 and goes through until 4, and then there's another candle which obviously for me is perfect time during my trading day. So also we've got a nice low risk opportunity to go long here. So what I did is I put my entry 5 points, the next possible entry point, which is 5 pips above. So the high there was 14,520. I got long at 14,525. Now to be safe, and because it's a low risk anyway, I put my stop right down below the low of this red candle. No point just putting it down below there, because obviously we've been down into this zone here and it could easily go down there, and it's so close anyway. I wanted to make sure that I was below there. And also, as I said in my Aussie USD candle video, the key thing is, in an uptrend, what we are looking for is a series of higher highs and higher lows. Well, we have fantastic series of higher lows here. Let's see how far back they go. Right from here, let's count them. There's our low, higher low 1, higher low 2, higher low 3, higher low 4, higher low 5, 6, 7, 8, 9, 10. So we've got 10 higher lows in a row. So obviously if I'm taking this candle here, I want to make sure that I'm still staying with the uptrend. Therefore my stop has to be below that candle there, because otherwise I could get stopped out even though it doesn't break the series of higher lows. So my stop is 5 pips under there. It's a very low risk trade, and as you can see, we're now nicely above this 10 and 40 moving average and looking strong. So I'm going to keep my stop there until such time as we make a clear new, well, we've obviously made a new high, but we don't know how high this is going to go. Let's say it gets to 15,000, then drops down into around here, and then moves up and makes another new high. At that point I can bring my stop up and put it underneath the next new higher low rather, and I can continue to do that. Now, had I been clever enough to get in here, I could have lifted my stop here, every single higher low I could have lifted my stop and protected more and more profits. That's what I intend to do if this continues to go up and up. And again, this is exactly what you can do. This is the 4-hour chart. Do it on the 4-hour, the 8-hour, the daily, the weekly, and find your own moving average buy zone in an uptrend using the moving averages that you think define the trend most clearly, and where price comes back in and moves away from the moving averages. It's a very powerful technique, and when it's done properly, like I just showed you, it's a very low risk technique, because you can risk a very small amount of money. And well, even what I've done has been here's my entry, 1 pip, 5 pips above there with my stop below there. You can see just visually it's about 5 times, it's already about 4 to 5 times greater than my risk. So I'm already 5 to 1 on my reward to risk ratio. But had you done it down in here, not that these were perfect entries in terms of the moving average buy zone, but well, let's say you'd done it down here, which is the best entry of all, you had a very, like what did I say, 125 point risk, and here we are, that was 13,700ish. Now here we are at 14,800. That's, well, I'm doing it in my head, that's about 8.5 or 9 to 1 risk, reward to risk ratio, and let's hope it continues. I hope that's helpful. Go and find your own ones. Have a look at all of your instruments. Find something that's already trending, come down to a lower time frame, see if you can find a nice moving average buy zone or a moving average sell zone to create your own low risk trades. Happy trading.